So let's now talk about estimating cash flows. When you're estimating cash flows, as you would have probably gathered so far, we're basically thinking of every project separately. What this means is this isn't just a sort of theoretical thing. This is a way of saying, let's focus in on which cash flows are important. So the important cash flows are going to be the ones that differ if you take on this project. If taking on versus not taking on this project doesn't change a cash flow, then that cash flow is not relevant for the decision. So we want to pick up cash flows that are an incremental consequence of taking on the project. They are the only cash flows that are relevant for considering the project. And making that decision, estimating those cash flows and determining them is going to affect your net present value calculation. So you've got to make sure that you get this right. Now, remember a point that maybe we've mentioned, maybe it hasn't come across very, very well. Net cash inflows and accounting profit are quite different. Remember that accounting does some stuff that is not necessarily relevant for decision making. For example, in accounting, we calculate depreciation, but depreciation isn't a cash flow. The cash flow that interests us is not the depreciation of that asset later. It's the acquisition, the spending of cash that must be funded at the outset of the project. So depreciation certainly doesn't count. We should also understand that accounting measures something. We know that accounting measures some things that aren't relevant for cash flow, but some of accounting may be indirectly relevant for cash flows. So we're zooming in on cash flows, but the accounting profit that's calculated, or to be more precise, the accounting profit that's calculated not under accounting rules, but under tax rules, may be relevant because it will affect the amount of tax that you pay, which is a cash flow. Okay, so we'll talk about that a little bit later when we discuss tax savings. Okay, so to evaluate a project, we have to identify what the cash flows are. We have to identify their timing. You've noticed already that we haven't got very fine about the cash flows. We haven't said it's this month or that month. We've basically lumped them in and said this one's at year one, this one's at year two. And for long run projects, that's probably all right. It's not going to make a big difference. However, if the project has a short period of existence, then, if we're comparing major expenditures in January versus December, time value of money will be relevant between those months, especially if interest rates and inflation are high. Okay, so the period might be much shorter, and in that case, we might want to predict using monthly cash flows and using monthly discount rates. But for most circumstances, that's not going to be something that we really need to do. All right, so let's talk about the cash flows that we need to think about. Up front, we're thinking about the investment. So we're thinking about how much money have we spent in order to get the project off the ground. Now, let's just be really careful with this. If you're looking to take on a new project, you're expanding your business, or you're acquiring a new business that's going to operate within your company, the assets that you have to buy in order to start that project are certainly going to be part of the initial cash flow. But something that might not be as obvious is the so-called increase in net working capital. For example, let's say that you've got a business, you've got a bunch of outlets, and you're looking at opening a new outlet. What are the costs of setting up that outlet? Well, yes, set up the shop, do the fit out, etc. But also, you've got to get some inventory in there. Now, I know that inventory is eventually going to be sold, but as long as that shop is open, you are carrying a certain level of inventory. So buying the inventory up front is almost like a capital investment, right? The increase in net working capital. You have to have money invested in there to deal with the fact that, hey, there's inventory there that cannot be productive somewhere else. I've got to have that inventory in order to do the sale. Of course, if this is a physical merchandising situation. There is cash that I've got invested there. I've spent some money, I've done some credit sales, I haven't got the cash back yet from customers. So any accounts receivable I'm carrying is also going to be part of the net working capital invested there. But of course, that will be reduced by any cash payments I get to delay in making payments to suppliers. Okay, so we need to think not just about physical things or direct physical things, but things like payables and receivables and inventory, which are, in a sense, an investment, right? You've got that is tying, those things are tying up resources. In addition, we also have to think of opportunity costs. What are you giving up by going into this project? So if you've spent some money before, in order for it to be relevant, if you've spent some money before and that's got a commercial value, you can sell it. And in order to enter into this project, you don't sell that, you're not picking up the cash from that sale, that's the next best alternative. That's a cash flow you're avoiding. So in a sense, that's an opportunity cost that is part of the cost of this investment. Okay. So that's basically what we mean by opportunity costs. Let's just be a little bit careful though. We do not include sunk costs. So if you've spent some money previously and it's got no commercial value, then you don't include it in cash flow estimates. For example, let's say that I undertake a survey that helps me determine whether I'm going to do this project or another project, and I invest that money into that survey. That cost of doing that survey or doing that analysis is not relevant for making the decision. Okay, look at this time-wise. I've spent the money. I then make the decision. The only cash flows that are relevant are cash flows that change due to the decision. If you've already spent that money on doing the analysis and you can't sell the outcome of the analysis or you can't get the cash flow back in any way, then that money that you've spent is irrelevant for your future decision. Okay, so just because you've sunk a lot of money into a project doesn't mean that you should not give up that project. Sunk costs that are in the past, are not relevant for your future decisions. The only time they can be relevant is if they can lead to a cash flow that's different between the two decisions that you're making. Okay. One other point that I need to make, we shouldn't be including financing charges either. Remember what we're doing with net present value. With net present value, by doing the discounting, we're basically saying, is this project giving us some value over and above our cost of capital? What's cost of capital? It's the cost of paying dividends to shareholders or paying interest on a loan. All those financing components are parts of the cost of cost of capital. They're not cash flows that get included in the cash flows we discount. They're incorporated in coming up with that value of R, the discount rate. Okay, so things like interest payments, dividend payments, loan repayments are not part of the investment decision. They're part of the decision about how we finance that investment and how we finance our investments in total. Okay, and so they're incorporated in the required rate of return. In other words, the discount rate.